Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, we're going to talk about Goldman Sachs article.
So we know that Goldman Sachs subscribes to this channel. So how we know is that this article almost verbatim says what we said in January.
They watch it. They probably ripped us off.
Yes.
But that's fine. We're used to that. Okay. Housing has never been this unaffordable, and home prices are only going to keep rising.
Mm-hmm.
That came out of Goldman Sachs. This is brand new. This just came out yesterday.
It was old news to us. But okay.
It's old news to us because we knew about this. Goldman Sachs figured this out, but we knew it a long time ago. We should open our own investment bank and do IPOs and manage trillions of dollars of assets for people.
Yes.
Okay, here's the first quote. Housing is even more affordable now than ahead of the 2008 crash, according to Goldman Sachs. First of all, I don't like 2008 crash. Home prices started crashing in late 2006, early 2007.
Right.
2008 was a free-for-all at the time.
And
But remember, we were already doing REO at the end of 2006.
Right.
The bank-owned homes.
And what bothers me is that everybody's comparing everything to 2006, 7, 8, 9, 10, 11. And look, people, housing cycles have had more than that one-off experience. And there are other housing cycles that I think are much more apropos to compare this one to than that one. Anyway,
yeah.
I digress.
Okay, here's the next one. But the bank expects limited supply and borrowers being locked in at lower mortgage rates to drive prices even higher. Something they're not talking about here, Juana. In 2006, only 16% of all homes were owned free and clear in the U.S. Mm-hmm. It's 42% now.
Right.
Okay, 42% are free and clear. And then of the remaining 58%, almost all of them,
all but 1%.
All but 1% are under 6%.
Right.
And you have a lot of people with under 3 or 4%. Mm-hmm. Actually, if you took the worst 5% of the market, the worst they have is probably 6 to 7.5%. Everybody else has way better loans. These people aren't getting rid of their real estate.
No.
Because the problem is they can't afford to rent. Right? Mm-hmm. Is this a weird phenomenon? When they say locked in, people are out there going, no, I own my home free and clear, or my payment's $1,100. I can't afford to rent. If I sold the house and have to rent, I can't afford that. It's too much money.
Mm-hmm. Right. And people have gotten accustomed to having these low mortgage payments because they've got these low interest rates. So that's going to be a rough adjustment for people going forward. Even people who can afford it are still going to have some severe intestinal discomfort. If you are accustomed to paying, $1,200, $1,500 a month in mortgage, $2,000 a month in mortgage, and you got the marketplace, and even if you were to sell your home and put all that equity down on another home, your mortgage payment is $4,000 a month. The affordability is only one piece. I think the psychological portion is much greater to overcome because, if you're going from, like I said, an under $2,000 a month mortgage payment to a $4,000 a month mortgage payment or more, it's a pretty bitter pill to swallow.
Yeah. And imagine this too. You're a single person, you bought a house in San Diego, really stretched the limit of your affordability, you bought a house for $400,000. That house today, let's just say it's worth $1 million. Mm-hmm. So you have $600,000 and you're like, I'll just sell it and take the money before the housing market crashes. Okay. So at $250,000, that's tax-free, but what happens to the remaining amount?
Hello, government.
Yeah. Taxes. Not only, they're going to pay taxes to a lot of people, state of California, the federal government, everyone's going to get their piece. So a lot of people are like, hey, I'm not going to realize it. I'll just keep it. Right. And that's locked people in. The tax policy has locked people in from selling their home. Right.
So we talk about this a lot. The taxation policy is partly having to do with money, but part of it is a social thing. And what I mean by that is taxation policy incentivizes certain social behaviors and punishes other social behaviors. So we've talked about this a lot as far as marriage penalty tax, children,
Right.
and all of that. So we focus on the money bit, but the money bit is really just a small portion. I think there's a lot more that goes into social engineering. And to that point, your position is a really good one, because if I'm that person who bought for 400, I'm single, I could sell for $1 million, that's $600,000 in gains, and I'd have to pay taxes on so much of that, now all of a sudden I'm in this position where I don't want to do that. I don't want to necessarily move or change jobs, or there are just so many facets of my life that now impacts, rather than just letting me have free choice and more choices. It limits people's choices, and I'm not fond of limiting people's choices.
All right. We continue to expect home prices to rise at a slow pace, strategists said in a research note immediately after watching our channel. They watch a channel, they make a bunch of notes, they handed it in. They probably gave them 2 weeks to do research, and they probably spent the first, almost the whole thing just goofing off, and then finally they went, "Oh my God, we got to turn in this research note. What do you want to do? Let's just go on YouTube and watch some videos and see what's going on. Hey, these guys look like they know what they're doing. Let's just copy their info, turn it in, okay?" Here's the actual quote from the article. Average prices will jump 1.8% year on year in 2023, and then another 3.5% by the end of 2024, provided there isn't any unexpected economic turmoil, the bank said in a forecast published Wednesday. Wanda, which one of these two numbers is the crash? Is going up 1.8% a crash, or is it going up 3.5% since the crash?
Neither.
I'm trying to figure out.
Neither, but when you were talking a moment ago, I just had this picture in my head, because it's mid-October, right? So it's term paper time. So I just kind of had this picture in my head of these, people at Goldman Sachs. These are the same people who did their term paper the night before it was due. And I that's just the picture I had in my head when you were talking.
Oh, no. You know what they did? They used ChatGPT. They just said, "Hey, Chat, we need something that looks like official that we can turn into Goldman Sachs." And it just went and grabbed a bunch of data on the internet and spit it out. And they just handed it in and said, "Hey, here's our work." Which is pretty funny, because I used ChatGPT to do some math, and then it was wrong, and people on the channel called me out and said, "Your math is wrong." I'm like, "Sorry." And it was funny, was the math actually was wrong, but it was wrong to our advantage. It proved our point even better, the math being wrong, because we were able to show, that it was better correlated. But it was funny because I trusted the math. All right, but they're not the only ones. A lot of people have predicted those price increases and everything.
Yes.
All right. Okay, here's the next one. Declining inventory levels have squeezed the housing market in recent years, with the U.S. short of anywhere between 1.5 and 5 million homes, according to estimates by NAR and Biden administration. NAR index tracking housing affordability U.S. fell a record low over June, July, according to most recent readings. Two things about this I want to talk about. One is the affordability, which is a short-term phenomenon. This changes as interest rate change, because affordability is literally what's the home worth and how much is your payment. Mm-hmm. Right? Okay. But let's talk about the shortage. This does not mean more houses need to be listed in the MLS. This does not mean that these homes don't actually exist.
Correct.
Why don't these homes exist? What has happened to make us short? And I've seen estimates that are closer to 8 million.
So the reason that these homes don't exist is because they haven't been built. And they haven't been built because builders, for one thing, are a little gun shy from the 2006 to 2012 episode. And the other reason is that building has become very expensive for them for a number of reasons, including regulatory costs, material costs, shortage of labor, cost of land, and of course, with the interest rates going up, builders want to make sure that they proceed carefully. They certainly don't want to carry any more inventory than necessary, so that they can protect their profit margins. Their profits are at an all-time high, and they like that, and they'd like to keep that going. They're in no hurry to build lots of homes. They are very much interested in maximizing their profits and not cannibalizing the marketplace. I just want to address a little bit what you said about affordability, mm-hmm. and that having to do with payments. Affordability is also about that down payment. So, to me, affordability, and as far as the prices, the mortgage payment is concerned, it's almost like a red herring. And let me
I was
explain.
going to use the exact same word.
And let me explain why. Because you can always lower your payment by buying less of a house, right? So maybe you're not buying a $500,000 house. Maybe you're buying a $375,000 house, and that lowers your payment, okay? That's fine. But I think that the big piece is that down payment. That down payment is a big chunk, and people who are renting have a hard time saving for that down payment because the rent, their housing cost is ever increasing, right? So this year your rent payment is $2,100. Next year your rent payment is $2,200. Last year it was $2,000. So the rent payment is forever increasing, and so I think that's part of what happens to them is they have a harder time saving for that down payment. And as home values increase, of course that amount of down payment will increase too, right? Because it's a percentage of that sale price. So when homes go from 375 to 500, now your down payment is having to increase substantially too. So I think down payment is a big deal. And I don't think it's talked about enough. I think everybody's focusing on payments, and I appreciate that, but I think down payment needs to be discussed too.
Okay, here's the thing. Housing affordability. This is only for people buying right now. If you were to walk down a neighborhood and start knocking doors and go, is your housing affordable? And they were a renter, they'd say, no, my rent's probably pretty high maybe, right? But if they were an owner, if you just door knock the owners in your neighborhood and walk down the street, this is what you'd get. The first person say, oh, yeah, I own it, free and clear. I'm one of the 42%. The next person say, oh, yeah, no, I don't own it free and clear, but I have a 3% loan, so my payment's only $1,100, and my next door neighbor told me he's paying $2,200 a month in rent, so my housing's super affordable. And actually, what you're going to find is almost everybody has the most affordable housing they've ever had in the history of housing. Housing has never been more affordable for the probably 95% of the population who are not selling. Why would they sell when they have the most affordable housing they've ever had? Think about this, New York City, rent control. You get that apartment. It was 1974. You got the apartment for $150 a month. They can only raise the rent like a very small amount, like 1% a year, right? So you literally have lived your whole life. We actually met somebody who lived 28 years in the same apartment in New York City. And I said, why did you live there? Because the person was a very, very high profile. If I said their name, you'd be like, oh my God, I know who that person is. They were a very high up political figure in the city of New York. But guess what? They were like, I got this smoking deal on this apartment. It's rent controlled. They can't raise my rent. I've been in this apartment for 28 years. Right? So why would you sell? The problem is it's only affordable for the people who don't own a home. But here's the next quote.
Unaffordable.
It's unaffordable. Unaffordable. Here's the thing. Existing homeowners have opted to cling to the historically low rates they locked in the last 15 years, with just 1% of Americans selling their houses over the first half of 2023. If you had 100 houses in your neighborhood, only one of them turned over on average in the first half of the year. In a normal year, you would have probably had 3 of them turn over in the first half of the year. You'd probably had 6 turnover in the whole year in your house, subdivision of 100 homes. So this is the thing. Yes, and this is why they're saying home prices are going to go up, because we're not talking about the 140 million homes in the U.S. We're talking about a very small number that will sort of churn. And then what are they looking at, Wanda? They're looking at the new home construction, which is not keeping up. We still have more births than deaths, right? We just did the boomer video. We have more births than deaths. And we have immigration. And then we also have more single person households than we've ever had, right? Household formations are up. So they're looking at this demographic data, and they're looking at these trends going, yeah, we don't see how prices would fall. The doomers think the doomers think it's 2005. That's their problem. Everything they've said and the Crash Bros would be 100% right if today was 2005 and all these people getting houses were 1-year ARMs that were going to adjust and nobody was putting money down and inventory was climbing. But this isn't 2005. It's almost 20 years later.
Not only that, but we have very few transactions. So let's kind of talk about that for a moment. So even those people that are not putting a lot of money down, even the people who maybe are getting more exotic loans, there are very few of them, right? Even at that, there are very few transactions happening, and even fewer happening that are, little money down and exotic loans. So it's completely different. In 2005, exotic loans were the norm, not the way it is now. And in 2005, people weren't putting money down. Not only that, but they were walking away with money at closing. So you're pulling money out without putting any money in. So it's a completely different scenario this time around.
Something interesting that I did read an article. So we have the least number of foreclosures we've ever had. And we're obviously not going to have many foreclosures because, like we said, 95% of the housing market's locked in. It's not going anywhere. And so banks, though, have decided when they sell their REO, when they foreclose on the houses they foreclose on, they're going to do the finance. They're going to do seller financing. Mm-hmm. They're going to seller finance it themselves. So they're like, hey, we know interest rates are 7.5 right now, but we're going to give you we'll give you a loan. We'll do it. We'll do a 6% loan if you buy the house. Mm-hmm. Now, Fannie Mae was doing that with HomePath, right? Mm-hmm. They had a special loan program. It was a better deal than everybody else.
Right, it's not unusual. And I don't know that they're going to give people a smoking deal. I think that maybe they might just reduce some fees, or they'll just sweeten the pot a little bit, but nothing too extravagant. Let's not think that it's going to be a deal. It's not.
Last quote from the article. Goldman Sachs noted that one benefit of the current tightness in the housing market is that there won't be a repeat of 2008, when home prices fell around 20% from their peak in the wake of the financial crisis. Now, clearly it's nothing like that. Mm-hmm. There are a lot of people who just, they can't wait for the housing crash because they didn't buy a house, or they sold their house and they need a crash to justify it. Or they think that somehow magically home prices will tank so much, they will easily just stroll in and buy a house, and everyone else will completely not realize home prices have tanked, right? And then magically home prices will go back up, and they'll be like, oh, well, I bought a house during the housing crash. So I really don't see that happening. If we thought that was going to happen, we would have sold all the rentals, right? And we know a bunch of people that sold their properties. We've talked about that before.
Right.
But this is nothing like 2008. There's zero, other than the unaffordability, but it's totally different because 95% of the market in 2006, 7, 8 did not have sub 5% loans. Guess how many people had a sub 5% loan in 2008?
None.
None.
I mean,
unless you were one of the 16% that owned your home free and clear, zero people. So the thing is you were incentivized to keep putting your house in the market and buying as interest rates drop because you get a better rate.
Right.
Hey, I'll sell this house and go buy another house. I'll get rid of that 7.5 and I'll get this 6.5 because rates are down, 1%.
Yep.
It took them 20 years to fall down to below 3%.
Right. All right. So
that was it for the
what
charts.
did you think? Is Goldman Sachs onto something? Have you gone back and seen our videos from January to track down exactly where we said what Goldman Sachs said recently? Let us know in the comments. We welcome all your real estate related comments. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.